University of Michigan's consumer sentiment numbers. The number comes in at 68.9 for the headline, down from 70.1 last month. Current conditions at 62.7, down from 63.3, and expectations 72.9. That's down from 74.4. Joining me, as always, Joanne Hsu is the Director of Surveys for the University of Michigan. Good morning to you up in Michigan. Let me ask you, you and I talked very briefly before this, and your feeling is these aren't much of a move. This isn't a huge change or shift in sentiment.
That's correct. It's a very small change. It's not really a meaningful change, especially for a preliminary reading. We shouldn't really interpret this as a decline in sentiment. It's really a no change.
What is behind it? I mean, to the extent that you can figure it out, this small change, what's behind it? I was looking through some of the data. Doesn't look like people are particularly worried about their jobs or their incomes over the next year.
Yeah, I mean, I think on the big things that impact a household's budget, their income prospects and the cost of living, those two are sort of offsetting each other right now. Consumers remain very, very frustrated by the persistence of high prices. They're consistent with the CPI print yesterday. They're a little concerned that the slowdown in inflation might be slowing down a bit. But at the same time, they recognize that labor markets remain relatively strong. With the Fed stepping in last month with the jumbo size rate cut, I think consumers, they believe that the Fed was going to step in to prevent labor markets from deteriorating. And indeed, we see that in their income expectations this month.
As a Fed watcher, what really stood out to me, obviously, is the 1-year price expectations go up to 2.9% from 2.7%. Is that largely on gasoline price fears because of what's going on in the Middle East?
We're not really seeing any specific references to what's going on in the Middle East. I mean, there are certainly some folks who are concerned about gas prices and gas price expectations are up a little bit. But in terms of the 2.7, sorry, the 2.4 to 2.7, 2.7 is still much lower than we were seeing earlier in the year. So it's still consistent with a continued slowdown in inflation ahead.
So nothing for the Fed to worry about in terms of people beginning to turn to accept the idea that we're going to see higher prices.
That's right. In fact, when we look at the long run expectations for inflation, that ticked down from 3.1 to 3.0. So consumers really are not, even though the short run expectations came up a bit, they're really not expecting inflation to come roaring back or anything like that.
What are they concerned about then? Is it just a general ennui?
No, they're concerned about the election. That's pretty clear. There are many consumers who tell us that the trajectory of the economy hinges entirely on who ends up winning the election next month, not last month. And so for many consumers, it seems pretty clear that they're reserving judgment. Some consumers are answering all these questions under the assumption that one candidate is going to win. It's not necessarily their preferred candidate, but they have been leaving these unsolicited comments that if the other candidate wins, all my expectations change.
That's interesting because when you look at the breakdown, Democrats and Republicans both are more confident this month.
Yes, that's right. So, I think there isn't much movement in terms of election expectations. We ask a couple of questions about who consumers believe is going to win the election, and that's not really moved much between September and October. So we're not seeing any major shifts in election expectations, and as a result, not too many changes in economic expectations either.
Yeah, looking at the Democrat, Independent, Republican expectations, they're all higher. Everybody seems to think that maybe we get through this election and things will be better, one way or the other.
Yeah, I mean, I think that broadly consumers believe that we are on the upswing. What we've been seeing over the past year is that expectations for business conditions have been improving pretty consistently over the last 2 years. And this month we're there's just like a very, very small improvement. But really, when we take the long view, what we're seeing is pretty substantial improvement in expectations for business conditions over the past 2 years.
If we leave politics aside for a moment, generally, how are people feeling in the sense that while these numbers aren't a big move, they're still depressed from what you would see in most recoveries and most expansions. What's holding people back now?
I think what we should really pay more attention to is the long run trajectory of sentiment rather than the level. It is absolutely true that the level of sentiment right now is below its historical average. But we also know is that consumers are feeling kind of negative, more negative now than they were 5 years ago before the pandemic on a number of dimensions. We see this in the psychology research that people express much higher levels of stress now than they did before the pandemic, even on issues, non-economic issues that really didn't change a whole lot between then and now. We also did some research earlier in the year about the types of news sources that people are consulting, and the proliferation of sort of click-worthy stories and posts on social media that could be contributing also to a slightly more negative baseline type of feeling. So I mean, I think it's too early to say whether this is going to persist. I think the main thing to notice is that yes, we may be below the historical average right now, but we're 40% above where we were 2 years ago. And so I think that is a sign of some recognition of improvements in the economy, particularly in the slowdown in inflation over the last 2 years.
Well, I know you look at news story impacts on consumer sentiment. Are you basically saying people are seeing a lot more bad news in the press these days?
They're reporting hearing more bad news, and it's not just in the press. The question that we ask about news they've heard about the economy could be at the barbershop, could be at church, it could be on social media, it could be any of these things. What I can say is that we've been tracking the share of consumers who have heard negative news about inflation, and the share that reported that they heard negative news about inflation was much higher during this most recent inflationary episode prior to this slowdown this year, relative to the early 80s and late 70s, when inflation was objectively much, much worse. So, I think that's really a reflection of the fact that sources of news are different. The news cycle is different. How people share information is totally different. You don't need to be face to face anymore to be sharing information with people in your social circle. I don't necessarily think this is a causal relationship. It could be that you don't feel good about the economy, so you're going to go and search for every news story or click on every post that confirms your prior belief. So I think if you have an underlying feeling that the economy is not doing great, I think the information situation out there is reinforcing that, and may slow down these transitions in how people feel relative to how quickly people's sentiment might recover in an economic recovery in previous periods.
You mentioned that the number of people complaining about high prices is higher than it was in previous cycles. I'm wondering if it's higher than it was a few months ago or at the beginning of the year. In other words, what are people's perceptions of inflation going forward and its impact on their lives? What have they been doing in the last couple of months?
Yeah, that's a great question. So on the surveys of consumers, there are at least 3 different places where we collect information on inflation and high prices. So one is the inflation expectations that's closely watched by the Fed. 2 is what I just mentioned. When we ask people, what news have you heard? We're tracking how many times people are spontaneously mentioning high prices. High prices is not an answer choice. It's just something that people spontaneously bring up. And the 3rd one is when we ask about their personal finances, we ask what factors go into their personal finances, into their assessment. And we're, again, tracking spontaneous mentions of high prices. So first of all, inflation expectations, as we've discussed, have slowed down, have softened and eased up quite a bit over the last 2 years. So that's, a pretty strong signal that consumers recognize that inflation has slowed down and that they expect it to continue slowing down. Secondly, on the news front, the share of consumers telling us they're hearing bad news about inflation, that has also come down as well. So, I mentioned it was previously higher than it was in the previous inflationary periods in the 70s and 80s. That's mostly referring to 2022 and 2023. In 2024, that's come down quite a bit. At the same time, a lot of consumers telling us they're hearing negative news about unemployment, even before we started seeing some labor market indicators soften earlier over the past few months. And then finally, in terms of personal finances, we've consistently had over 40% of consumers spontaneously telling us that high prices are weighing down their personal finances all year long. That really has not changed much at all. So in spite of the fact that consumers fully recognize that inflation has slowed, that they recognize that the news that they're hearing around them and they're seeing around them indicates that inflation has slowed down, they're still really, really frustrated by how persistent high prices have been.
How do we see, if we can see, any reaction to the Fed's larger than expected rate cut this past month?
We didn't really see much evidence of a reaction right around September 18th, but we weren't really expecting one either. It's pretty unusual for consumers to pay attention to a policy announcement or an FOMC, a Jay Powell presser. Like they're not paying attention to that. That being said, they are paying attention to news around them about interest rates that they are observing around them. And when we're asking about buying conditions for large purchases like cars, durable goods, and homes, the share of people who are concerned about high prices for those things have all dropped this month. So, I think that's all consistent with the fact that consumers have noticed that that interest rates are falling. And when we ask them directly about their interest rate expectations, we have 54% of consumers telling us that they expect interest rates to continue falling in the year ahead. And that's just down. It was 54% this month. It was 55% last month. That was an all-time high since we started collecting this data. And so that's not much of a change. We didn't see any change in that before and after September 18th. So, jumbo rate cut or not, their consumers are expecting interest rates to continue slowing.
Do you notice any movement in the number of people who think it's a better time to buy a house?
People definitely are feeling a little bit more optimistic or favorable about home buying conditions, specifically because of this drop in interest rates. And mortgage rates came down kind of well in advance of the rate cut announcement. But that being said, we are near historic lows in terms of how it's a bad time to buy a house. And so we've been seeing a modest improvement as mortgage rates have fallen, but we still have a majority of consumers telling us prices are excessive. Home prices are really high. So I think it's going to take more than a 50 basis point cut in interest rates alone for consumers to feel like it's going to be a good time to buy a house.
Before I let you go, I got to ask about what's been in the news lately, and that's the hurricanes. Milton, probably too late for your survey, but Helene certainly did a lot of damage in the Southeast, and I'm wondering if that affected A, your survey responses, and B, people's feelings about the overall economy.
So we didn't get too many explicit mentions of hurricanes. As soon as Helene, kind of started forming over water, we started tracking mentions of hurricanes, and we just didn't have too many people. We didn't have too many people mentioning that. We are sort of watching how many of our consumers in the Southeast are answering our survey, and we give people several weeks to respond to the survey. So we'll see at the end of the month if the composition of our sample has been affected by that. But explicitly, we don't have that many people mentioning the hurricanes. We have a lot of people mentioning the election. So if it's on their minds, it's not being connected to the economy.
Well, we'll see, I guess, at the end of the month when we get the final results, and we will talk to you for the next preliminary results when we get to November.